Hello, everyone. My guest today is Andy Tryba. He's currently running Think3, which is getting very, very active in the B2B SaaS space. He also has his own operating experience in many of these companies. We're going to dive in today. Andy, are you ready to take us to the top?
Absolutely.
All right. So for folks that have not heard of Think3, kind of tell us what the fund does and how you operate, what you look for.
Sure. Yeah. So Think3 is a $1 billion fund specifically designed to give SaaS founders another chance to get another shot on goal, right? If you think about a lot of these companies, if they raise a bunch of money and they're growing at double, triple on their revenue, that's great. But a lot of these companies are growing well, 20 or 30%, but they're not going to grow a horn anytime soon. So what we do is we enable those founders that are kind of stuck in this situation to then go start something else. And we buy those company founders $1,000 and basically a non-equity gift to go start something new.
And give me a sense of, we know we're just talking about business apps, but give me a sense of one or two deals you've done so far, just to really make the picture clear.
Sure. Yeah. The business apps is a perfect example, right? So Andrew Gazecki started that when he was in college, grew the company to several $1 million. It's growing great, but, he's been doing that for quite some time and he wanted to go start something else. So there wasn't really a liquidation option for him. He certainly wasn't going IPO or anything like that. So we got together, we talked about, what else he was interested in. So we looked at his current company, we bought it, we took it over, and now literally we're setting the foundations to run that for the next decade while he goes off and starts his next company.
Yeah, we had him on back in, I want to say it was August of last year. And, he gave us some of the data, right? Founded in 2010. He'd raised, I think, entirety about $110,000, which is just incredible considering he shared his MRR number about 1.5 million a month, less than 2% churn, $500 ARPU across a customer base of over 3,000 customers. And I'm just sitting here going, wow, I wonder how he takes money off the table here, because if you founded it in 2010, people are going to look at 8 years and go, he should be way bigger than this to go the venture route, right? But secondaries are an option, and that's where it's a perfect fit for kind of the Think3 model. Give entrepreneurs liquidity, let them go do their next thing.
Exactly right. And we fundamentally believe that there's all of this pent up intellectual capital in people like Andrew, right? So obviously, great startup founder, tons of idea. But he's, in with that company that, didn't really have very many options at that point. So except for to run it forever. So that's what we'll do. Let him go off and go do something absolutely great. And if you look at a lot of unicorns, for example, something that Cowboy Ventures did an analysis on, they 90% of those teams that actually worked together in the past, and the average founder age is actually 34. So, you look at that and you're like, hey, find founders like that, give them an opportunity to sell their current company, to go take their teams and go start something else.
Yep. No, it makes a lot of sense. So how many deals have you done today? Well, first off, when was the fund launched and how many deals have you done up to this point?
Yeah, so we launched the fund, I guess, about 8 months ago or so. So it's relatively new, but we're actually a part of ESW Capital. And ESW Capital, we've done 65 deals over the last decade or so. So we come with a lot of operational experience, but this fund specifically of our SaaS founders is relatively new. So we've only done a few deals to date, but we've got a ton of inbound requests, and now we're basically evaluating a lot of those deals.
When the news came out, I remember, because I'm an LP in a lot of funds, I said, hey, what are your thoughts on this? And they said, oh, this is good marketing by ESW. Maybe there's like $1 billion, maybe it's not $1 billion. But regardless, this story of helping founders get liquidity who don't fit these other molds is a great story, and they'll get deal flow from it. It seems like that's panned out exactly probably how you planned.
Yeah, no, it's been great. And, we obviously didn't just do it for the story or the lead gen element of it. As a founder myself, I've started 5 companies, I guess, over the last 15 years. And I feel for these founders, and you want to build these great companies. And whenever you are a founder, you're always getting beat up on, hey, your idea is dumb, you're dumb, you don't know how to run a company, et cetera, et cetera. So you always fight that, and you convince yourself that you have to protect this company that you've done, and therefore you get wedded to it, versus saying, hey, you know what, that was my first draft. Great. You know what? Let me find a quick exit. Let me go to draft 2, draft 3, draft 4, draft 5, and really create this portfolio-like effect with your life. Because you really only have 15 years or so to be a founder. Because at some point, you're sick of eating ramen noodles and you got kids and all that other good jazz that catches up. So but you want to take as many shots on goals as possible. So we created this to go and make that happen for them.
I'm curious how, and you can't obviously talk, I imagine, about specific negotiations, but from a psychological perspective, if I'm Andrew and I run a company doing 1.5 a month, right, and only a 110 in, so I'm in full control, I can essentially pull cash out however I want. It's hard for me to get excited about selling that unless the multiple is just through the roof. You obviously don't want to pay a multiple through the roof. So there's a give and take. You have to kind of tell the founders the story you just told me, which is you've learned so much. Get out of this. Go take a second shot. We'll support you. Walk me through, for founders listening right now that might be great deals for you, what other things would you tell them where it's worth giving up that cash flow for them for the lump sum check from you?
Sure. Yeah, no, I think that's a fair question. And I have this conversation a lot with founders. And basically I tell them is within that first 3 years of you starting the company, you kind of know at that point whether or not that hockey stick's going to occur or whether it's not going to occur. Everyone talks about, pivot this, pivot that. Look at what Slack did. But that's incredibly rare. Kind of back towards that same Cowboy Ventures analysis, 90% of those unicorns never pivoted. Right. And we created this cute little word called pivot that sounds really awesome. But in reality, back in the day, we would say, OK, that idea sucked. It didn't work. So now I'm going to go try another one. And simply so when I tell founders, I'm like, guys, in the first 3 years, if you are, growing your revenues again, triple, double, triple, however you want to, it's got to be triple digit CAGRs year on year. And if it's not, then you need to take a good hard look and say, is this company ever really going to have that hockey stick? And it could, again, be a fine company growing at 20 or 30%, but is that your best shot? And do you want to go do that for the next 8 years and really have 2 shots on goal or maybe 1 shot on goal in your entire career? Or do you want to say, hey, you know what? I'm going to take my learnings and I'm going to go do something else, even if there is cash flow and what have you that's coming out of that. Like, what's the opportunity cost for your next venture? And that's the discussion that I like founders to get into, where they're like, great, every 3 years, if I do this, man, over that 15-year time period, I can take 5 shots on goal versus 1 or 2. And, what are your odds of winning the game at that point? So,
yeah, we're all in Austin, Texas. Vista Equity is maybe the largest buyer in the private kind of B2B SaaS space. You're in the same building in the Frost Tower downtown. Someone's listening right now. What makes you guys are very different fund sizes, things like that. But what would make you, where are you two different? What would make Vista a better fit for a company versus you and vice versa?
Sure. Yeah, no. So I know the Vista guys well, Brian and Robert. I've got tons of respect for them and what they do. And they're obviously the world's best. So, I'm humble enough to say I'm not even in the same sentence as what they do. And they obviously have to put a lot more capital in play. So we go all the way down into the, $3 to $5 million range of these SaaS companies. And I think that's a space that they just simply don't play in because they've got to, be looking for $1 billion or several $100 million companies. So we're much, much smaller. And I think that also enables a lot of these SaaS founders, again, to kind of fit into our envelope versus say something that a larger firm like Vista would go after.
Yep. And do you look at, are there any minimums for you in terms of, hey, we've got to see at least this much growth year over year, net churn on a revenue basis lower than this? Any kind of hard metrics like that you need to be above?
Yeah, we look for definitely ARR, north of 3 million, ideally in the 5 to 10 million, and then we also look for a gross retention of at least 80%. And what that simply tells us is you have something that's sticky, right? And all the things that we purchase are in that B2B space. So we do look for that stickiness. Now, it doesn't actually have to be growing at some percentage, and also doesn't really have to be profitable, because what we really do is we take that team and we use kind of our horizontal core competencies to have a shared engineering or shared finance and things like that. And that's actually how we're able to run these companies forever. In that, many of these SaaS companies, unfortunately, they don't have economies of scale because they're only $2 to $5 million, and therefore, it costs a lot to have the help desk software, the Salesforce software, and what have you. So by leveraging that across a lot of these, then we can actually run them profitably.
And walk me through kind of what your kind of the SWAT team you've articulated, what it looks like. So there's you. How many other people on the Think3 team?
Yeah, so I guess I would separate the Think3 team into the folks that run the business and the folks that kind of work with the entrepreneurs early on, because obviously we've got a funnel of folks that work with sales side investment bankers, look at the inbound leads coming in, go to the shows like SaaStr. We just came back from SaaStr Europe, for example, right? Talking to a bunch of entrepreneurs and things like that, and whether or not it'd be the right fit for a model like this, and whether or not it makes sense for their company. So there's a handful of folks on that side of the world that kind of evaluate those deals as well as talk to entrepreneurs. But the bigger team is on the operational side. Because again, when we buy these companies, we're not buying it to shine it up, throw some debt on it, and try to go find a buyer. We're buying companies that we feel that we can run for the next decade or two. Right. So the first thing that we do is we really look at the core foundation of the product and ensure that we make the right technical decisions on, perhaps even rewriting the underlying software if it was kind of done without the right level of software diligence. We then go to the customers and we really focus on customer success, and we apply a customer success team on that. So we've got, we share a lot of those resources with ESW, but there's definitely in the thousands when it comes to a lot of those shared resources.
Who do you keep? So business apps just happened. Do you keep the whole team in San Diego, and then your team is you came in kind of as CEO, and there's maybe other people you put in as consultants or something? I'm curious what the ratio is there.
Yeah, so a part of this Think 3 model is actually enabling the founder to take his team with him.
Okay.
Right. Or as much as his team as he would want. Now, obviously, within the first 100 days, we do a pretty extensive knowledge transfer system where we do, basically peer everything, peer programming, peer support, peer customer engagement, red line deals, the whole 9 yards. And so we assume that nobody's going to be there. Now, with that said, we like to keep some of the core talent and what have you that's there, but we basically designed a model where even if everyone were to leave, we can continue to run the company profitably.
And yeah, that's not easy. It'll be curious as you build up your sample cohort here of these companies, and maybe you publish articles on this or give more interviews in a year or two to hear how you really master that process. Because I know Vista obviously is using a consultant approach, keeping most of the team. You're coming in as CEO. I want to talk about your schedule for a second. So if I just look at your LinkedIn, and I'm sure this doesn't even cover everything, it seems like you're coming in as CEO as most of these companies, right? Business apps, Engine Yard, there's a few others. I mean, what does your day-to-day look like? Do you spend a Monday on one, a Tuesday on another? What's it look like?
Yeah, so I actually don't. I try to do as much horizontal as possible. So I'll look at, I'll have a horizontal renewals team, for example, and I'll spend time talking about renewals and how we're doing across all of the groups. I'll have a horizontal customer success team, for example, that will talk about the health of each one of the company's top customers and upcoming QBRs and things like that. Same deal with support, same deal with engineering and what have you. So obviously there are customer specific meetings as it relates to the companies, but for the most part, everything else I try to run horizontal. So therefore I then just stack rank my priority for the quarter, and then I stack rank my priority for the month. And then I apply percentages of the week that I basically would apply to each one of them. And then I calculate that times the number of hours. And then my awesome admin makes sure that I spend exactly that many hours on those particular activities. And I find that, since and people forget this, so there's 168 hours in a week. And even if you were to sleep 8 hours a day, every day, that's 56 hours. So there's 112 hours left over that you're well slept and you're awake, right? So it's like, how do you then want to leverage that 112 hours? And obviously, I've got kids and family, so you want to allocate a certain amount of time for that also. But the rest of it, there's more time in the week than people realize. And it's just how you actually prioritize that and how do you make sure that that time doesn't bleed. So I'm not quite as diligent as, say, Elon Musk going to the 5-minute increments, but yep. I'm a big fan of ensuring at least you understand where your time goes.
Let's talk about returns. So this kind of fund, it sounds like you said you want to hold it for decades. Are you just taking cash flow, paying dividends out to LPs? What's the return look like for LPs? Or is your only LP ESW? So it's really kind of streamlined there.
Yeah, no, it's a tight set of investors for sure, and ESW is obviously the majority of that. So that ends up being nice from a simplicity perspective and what have you. And then we operate these on whatever margin structure will make sense for these businesses. And oftentimes, you can do anywhere between 50 and 70% net margin. A lot of these businesses because of the fact that you're kind of running them horizontal.
Mm-hmm. And no debt. You haven't put any debt on any companies you've done.
No debt, all cash deals.
Yeah,
and that's one of the we win a lot of deals because we are all cash, and then we close in 30 days, right? I mean, it's a fast cycle. We don't do we don't throw a lot of these guys through these crazy processes and what have you that takes 3 months or whatever else it may be.
Well, Andy, sorry, I meant on the back end of that. So let's say you close with cash because you have that cash pile, but afterwards, let's look at business apps, for example. A company like Hercules would come in on 1.5 monthly, right? They would go up to maybe 36 months of ARR, help you take down your equity portion of that deal after the fact, even after you made it streamlined for the founder. Will you put on equity after the deal? Debt?
Yeah, no, we won't put any debt on it because again, we're running this all for cash. and we're running it for the next several, in a decade or two, right? So whenever you have a 10-year or a 20-year horizon on running these companies, you don't want to actually put on debt and things like that and service that. You want to just kind of run it profitably and run it great for, however long as you can, and continue to grow the business.
Interesting. Even if you get great interest rates and that lump sum cash up front from the debt component allows you to then go reinvest on other things. It doesn't make sense for you.
Yeah, no, we use a small amount of debt on some of the larger deals within ESW. I think we did Jive software last year for whatever, it was $450 million or whatever. So sometimes in those scenarios, we will leverage the debt side of the world, but we're big fans of just pay cash for it, run it profitably, run a great company.
Yeah. And I would say the Jive deal, I always, because I have so many conversations like this, I forget sometimes which ones are private and which ones are public. So I won't talk specific numbers, but I do have a friend very close to all of the Jive action, and the numbers were incredible what you guys have done there. So I know it seems to be working. It seems to be doing well. Let's wrap up here, Andy, with the famous 5. Number 1, what's your favorite business book?
My favorite business book is probably Made to Stick by Chip and Dan Heath.
Number 2, is there a CEO you're following or studying right now?
I'm a big believer in, I love everything that Andy Grove does. I was at Intel for 14 years. So everything I get my hand on, everything from the high output management to, Only Paranoid Survive, you name it. I read everything about Andy.
Number 3, what's your favorite online tool for building and running all these companies?
Favorite online tools. Let's see. So I'd probably say that my Work Smart tool that we developed as part of Crossover is my favorite tool, because it's all about time management and how you're really spending your day, and the analytics around all that is super important in my life.
And number 4, how many hours of sleep do you get every night?
I'm healthy on the sleep side. I probably average 6.5 to 7 every night.
That's good. And situation, I know you mentioned kids and married earlier, but married, how many kids?
Yeah. So married, I've got 2 kids. I've got 2 little girls, a 9-year-old and a 7-year-old.
Oh, great. That's great. And how old are you, Andy?
I'm 40. I just turned 40 this year.
Oh, congratulations. Great. Last, depending on if people value that or not, right? I'd say congratulations. It means wisdom, right? Some people go, don't call me old. I want to be 40. I don't want to be 40. All right. Take us home here. Last question. What do you wish your 20-year-old self knew?
I wish my 20-year-old self knew that you can swing for the fences, and sometimes you hit the ball and sometimes you miss the ball, but get up and swing again. I do wish that level of thinking was more permeated across the young kids, because literally, particularly when you're 20, you got nothing to lose. You literally got nothing to lose. Like, swing for the fences, guys, and go at it.
Guys, swing for the fences. You've got nothing to lose. Again, Andy joining us, did his own thing for many years. Big deal at Intel, learning, building there, and then eventually joined up with the ESW team and eventually Think3, recently launched $1 billion basically buyout fund. Think of it almost like micro Vista equity, right? Buying companies like business apps, doing somewhere between as little as 3 and 5 million in ARR up to much larger deals, building them, running them, and then applying horizontal management to make them efficient afterwards, holding them for a decade to do 2 decades, taking margin to generate those returns. Andy, thank you so much for taking us to the top.
Right. Thanks, Nathan.